Welcome to Iron Financial. Our mission here is to help you forge a stronger portfolio. We do that by cutting through all the market noise and really stress testing the fundamentals. Today, we're putting a unique REIT through the gauntlet, Easterly Government Properties, ticker DEA. Now, they've got a simple, really powerful story. They are the landlord to the United States government. So the question we're here to answer is whether that foundation is built on solid rock or on shifting sand. Is this company a financial fortress, or is it just a hollow facade?
So let's just start with the central pillar of their entire business model. The way they bill themselves is as the ultimate landlord to, well, the world's most reliable tenant. I mean, the U.S. government doesn't bounce rent checks, right? They sign long-term leases for buildings that are absolutely essential to national operations. So on paper, it sounds like the perfect low-risk setup for any income investor. But as we all know here at Iron Financial, the devil is always in the details. Is it really that simple?
Exactly. It's never that simple, is it? Look, on one side, you have what looks like the most guaranteed income stream on the entire planet. We're talking unshakable credit, multi-decade leases for assets the country literally can't function without. That's the steel frame right there. But on the other side, your single biggest client is the U.S. government. And that means you're tied directly to the whims of politicians, to the budget battles in Congress, and, yeah, mountains of bureaucratic red tape. So we're here to see which one of these forces is stronger. We're going to hammer on both sides of this thing and see what gives. All right, let's get right to it. Here's our blueprint for today. First, we'll start with the company's core story. Then we're going to forge our way into the financials. From there, we'll examine their income blueprint before we really start stress testing the foundation, looking for any cracks. And finally, after we hear management's defense, we'll deliver our verdict. Is this thing steel or scrap? Okay, Section 1, the government's landlord. You know, the story that Easterly sells is incredibly straightforward, and to be honest, it's very appealing. They don't just own generic office buildings. No, they own purpose-built, mission-critical facilities. I want you to think FBI field offices, federal courthouses, secure laboratories for the FDA. These are not optional spaces. They are absolutely integral to the ongoing operations of the country. They lease these specialized assets to government agencies on long-term contracts, and they're aiming for a strategy they describe as both durable and repeatable. And there it is. That's the core sales pitch, straight from the CEO's mouth. I want you to pay close attention to that phrase, independent of political or economic cycles. Now, that is a very, very bold claim. It's the central pillar of the entire bull case for this stock. Management is basically arguing that no matter who is in the White House, no matter if we're in a recession or a boom, the FBI is going to need its offices, and veterans are going to need their VA clinics. We are definitely going to test the foundations of that claim later, but for now, let's see if the numbers from their latest earnings report actually back up that story.
Okay, Section 2, forging the financials. Now it's time for the heavy lifting. A good story is completely worthless if the numbers don't support it. So we're digging into the raw data from their Q4 2025 earnings call to see if the company's operational health is as strong as they claim it is. First up, the headline number for any REIT, Core Funds from Operations, or FFO. I want you to think of this as the company's real operational cash profit. It strips out all the non-cash expenses like depreciation. It's really the key metric for a REIT's health. And for the fourth quarter, Core FFO per share came in at 77 cents. That's a nearly 6% jump year over year. That's a solid, concrete start. Now let's look at the stability of that cash flow. Occupancy, well, it's rock solid at 97% leased, which is near its historical highs. You got to remember, when your tenant is the U.S. government, they don't just pack up and leave. And this stability is anchored by a weighted average lease term of about a decade. We're not talking about short-term tenants here. This is all about locking in long-term predictable rental streams. Okay, let's look at the full picture for the year. Full year 2025 Core FFO per share was $2.99. That's up nearly 3% year over year. Now let's be clear, it's growth. The arrow is definitely pointing up, but it's not exactly setting the world on fire, is it? This isn't some high-growth tech stock. This is a slow and steady battleship. So the crucial question isn't just that it's growing, but is that growth durable? Is it actually built to last?
And that is exactly the point management wants to make. The crucial point here is all about consistency. Just look at this table. They laid out a strategic goal of delivering 2 to 3% annual FFO growth. They hit it in 2024. They hit it again in 2025 with nearly 3% growth. And their 2026 guidance, if you look at the midpoint, it points to another 3% growth here. This is the very definition of a repeatable process. They are doing exactly what they told everyone they would do. This isn't about explosive growth, it's about building a predictable income engine, brick by brick.
Okay, fine. The top-line numbers look stable, just like they promised. But what about the quality of the assets they're actually buying? Let's move on to Section 3, Blueprint for Durable Income. I really want to know if the steel they're acquiring is as strong as the financials are suggesting. That's a fair question. So let's look at their latest move, because it really illustrates their strategy in action. Subsequent to the quarter's end, they closed on a 3-asset portfolio from the Commonwealth of Virginia. Now, this isn't just another purchase. This is a case study in what management likes to call value-creating opportunities. Let's break down the mechanics of this deal.
The key number here, the one you need to focus on, is the yield. They acquired this portfolio at an 11% initial cash cap rate. Now, to put that in perspective for you, a cap rate is basically like the annual return you'd get on an all-cash purchase. Getting 11% on a government-backed asset in this market, that's incredible. It's immediately accretive, which just means it boosts earnings per share from day one, because that yield is far, far higher than their cost of capital. Whoa, hold on. An 11% cap rate? That just screams risk to me. The market isn't stupid. Nobody just gives away free money. The CFO herself says it was a motivated seller. You know, that's Wall Street code for someone who is desperate to get out of a property. I dug into the filings and I see a lease expiration coming up in 2027. So did they just buy a problem asset that the seller knew was about to go vacant? Did they overpay for some short-term gain that's going to become a long-term headache? That's the first thing you check, and it's exactly what an analyst asked them on the earnings call. Management addressed this head-on. That 2027 expiration that has you worried? It's for a tiny 2,000 square foot space. They actually called it very immaterial. It's a rounding error. The real value in this portfolio is tied to the 2 main leases, and those don't expire until 2034 and 2036. So this wasn't some hidden trap. This was a tactical win. They used their all-cash position and their ability to close quickly to take advantage of a seller's specific situation. That's not risk, my friend. That's just smart capital allocation. All right. I'll concede the Virginia deal looks smart, but a few good bricks don't make a fortress. Now it's time for Section 4, Searching for Cracks. Let's really stress test this company's foundation. First things first, let's talk about the biggest line item on any REIT's balance sheet, debt. Their net debt to annualized EBITDA is currently sitting at 7.5 times. Let's be perfectly clear. That is high. That's a heavy load to carry, and it makes them really sensitive to interest rate fluctuations. Now, management says they have a medium-term objective to get that down to a more conventional 6.0x, but right now, today, they're running heavy. This is the first potential stress fracture we found. And this is the number that should make any income investor sit up and really pay attention. A 600% dividend payout ratio. You heard me right, 600%. Based on their reported GAAP earnings, they are paying out 6 times more in dividends than they actually earn. Their annual dividend is $1.80 per share, but they only earned 29 cents in net income last year. How is that even remotely sustainable? This doesn't look like a stress fracture to me. This looks like a massive structural red flag. And finally, we come back to the biggest risk of all, political risk. So much for being independent of political cycles. An analyst on the earnings call did their homework and listed out the budget reality for some of their key tenants. The FBI, a $1 billion cut. The DEA, a $200 million cut. The IRS, another $1 billion. The EPA, $4 billion, and it goes on and on. These are not abstract risks. These are direct threats to lease renewals, to tenant improvement allowances, and to future growth. This is the political headache I was warning about at the beginning, and it is very, very real. Those are absolutely the right questions to be asking. The high leverage, that scary-looking payout ratio, and the headline budget cuts, that is the core of the bear case. And that bear case is worthless if the company can't withstand the attack. So now, let's look at management's reinforcements. How exactly are they defending their fortress against these very valid points of concern? Look, management isn't ignoring these issues. They have a clear 3-part plan. First, they're going to deliver that steady 2 to 3% core FFO growth. Second, they're going to diversify their tenant base by expanding into state and local governments, just like they did with the Virginia deal. And third, they are going to systematically bring that leverage down to their 6.0x target. This isn't panic. It's a long-term plan, and it's already in execution. Okay, let's tackle that 600% payout ratio head-on, because it is, frankly, the most misleading number in this entire analysis. That figure is based on GAAP net income, EPS. For a real estate company, that is fundamentally the wrong metric to use. Just throw it out. Why? Because GAAP requires them to deduct huge non-cash depreciation charges from their earnings. But think about it. Their buildings aren't actually losing value. In many cases, they're appreciating. The number that actually matters for a REIT is Core FFO, which adds back that non-cash depreciation to show you the actual cash flow. DEA's full-year FFO was $2.99 per share. Their dividend is $1.80. The FFO comfortably covers the dividend. That 600% figure isn't a red flag at all. It's a statistical illusion caused by using the wrong accounting standard. The dividend is safe. And as for those budget cuts, this is where CEO Daryl Crate makes a really fascinating, counterintuitive argument. He basically flips the entire narrative on its head. He argues that these budget cuts are actually a long-term tailwind for Easterly. How? Well, because when agencies are forced to tighten their belts and become more efficient, the first thing they look to get off their books is the capital-intensive burden of owning and maintaining real estate. It's just cheaper and more flexible for them to lease from a specialized, efficient private partner. So Crate argues these cuts don't mean less demand for space. They mean a structural shift away from government ownership and towards leasing from companies like DEA. It's a powerful and, frankly, logical point. Okay, you've presented a solid defense. I'll give you that. You've explained the dividend coverage, and you've offered management's counter-argument on the budget cuts. But that doesn't just make the risks disappear. Now it's time to weigh all the evidence. It's time for the final judgment. Let's put the bull case and the bear case side by side and see which one is heavier. All right, this is the final weigh-in. The bull case, the steal. It rests on a foundation of durable, predictable cash flow from an absolutely essential service. You have stable 97% occupancy, you have long leases, and you have a management team that is delivering on its promise of consistent 2 to 3% FFO growth, which is reinforced by smart, accretive deals like that Virginia portfolio. Now, the bear case, the scrap, it's built almost entirely on external risks. That high debt load at 7.5x, the sensitivity to interest rate changes that comes with that debt, the constant political headline risk from budget battles, and just the simple fact that this is a slow growth stock in a market that often chases speed. So what's our verdict here at Iron Financial? Easterly Government Properties is not a trap. The company's operational strength is real, the cash flow is durable, and that dividend is well covered by the correct metric. The management team appears to be navigating a really complex environment with a lot of discipline and making smart capital allocation decisions. However, it's not a simple, impenetrable fortress either. The risks here are not trivial. Exactly. The risks are just as real as the strengths. That high leverage is a governor on their engine. It puts a ceiling on their growth potential and makes them highly sensitive to the capital markets. This is a slow-moving battleship, not a fighter jet. So, the crucial question for you, the investor, it all comes down to this one question. You have a steady, predictable 3% growth engine and a very attractive 7.4% dividend yield. Is that combination enough compensation for the risks that come with being a highly leveraged landlord to the U.S. government? Does it fit the construction of your portfolio? That's the analysis. That's Iron Financial.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.